Hey everyone, and welcome back. This monthly update video for February, we have a lot to cover, from interest rate changes, property prices, key changes for first home buyers to Australia, and global and Australian market shakeups. So let's dive straight in. As always, this video is general in nature and designed for my clients, family, and friends. Should you have any questions, please do not hesitate to contact me. Right, let's get started on the RBA interest rates first. Australia's made a significant shift in its monetary policy, cutting interest rates by a quarter point to 4.1%. This makes it one of the last developed economies to ease rates, with Japan being the only exception as it moves in the opposite direction. RBA Governor Michelle Bullock attributed the rate cut to slowing inflation, now at 3.2%. Market pricing now reflects fewer than 2 additional cuts this year, pushing the Australian dollar higher against the US dollar. Economic growth has been weaker than expected, with quarterly GDP rising just 0.3% and annual growth at 0.8%, both below forecast. Yet despite this, the housing market has rebounded. A short-lived downturn has been almost erased, with property values rising 0.3% in February. So in short, Australia's economy is at a turning point. Interest rates are easing, but cautiously. Growth is subdued, yet confidence is building, especially in the housing market. The months ahead will be critical in determining how these forces shape the financial landscape moving forward. Now, with these rate cuts, it is important for you to call your bank to ensure they pass on the rates. Alternatively, if you reach out, we can put you in contact with a mortgage broker that can review your interest rates to ensure you are getting the best available at them. The best rates we are seeing currently are sitting around 5.5% for fixed for 2 years and 5.74% variable. Therefore, if you still have a 6 in front of your mortgage rates, you need to get these reviewed immediately. Now, another major change in the housing market is for first home buyers. This allows first home buyers to rent out a room while still claiming stamp duty concessions. Previously, buyers lost the eligibility if they leased part of their home within a year of moving in. The policy applies to properties starting between September and June 30 next year, with the possibility of this being made permanently in the future. The change benefits first-home buyers purchasing properties up to $700,000, removing previous restrictions that had affected thousands of first-home buyers. Now we move on to the US market. The announcement of the new US tariffs on goods from Canada, Mexico, and China sent markets into a sell-off. Therefore, for the month of February, we had seen a 2.2% drop-off on US markets. Now, when we look back at history and the trade war of 2018-19, this showed us how tariffs can disrupt supply chains, increase costs, and create uncertainty. Businesses held back on investments and hiring, and markets became volatile. But once a trade deal was reached, confidence returned and stocks rebounded. This time, markets reacted negatively because many assumed tariffs would be used as a bargaining tool rather than actually implemented. While tariffs can cause short-term inflation, the big concern is slower economic growth. If these tariffs stay in place, or if more are added, the impact could be felt more widely. Retaliation from trading partners would only make things worse. Already, we're seeing signs of uncertainty, consumer confidence has dropped, and business investments have slowed in the US. While the economy is still strong, tariffs add risk. If history tells us anything, it's that markets will adjust, but only if trade tensions don't escalate further. The key takeaway: tariffs create economic headwinds, but they don't necessarily derail growth, unless they linger too long or keep expanding. We'll need to watch how businesses, markets, and consumers respond in the coming months. Now we move on to the Australian share market. The Australian market is facing its toughest earnings seasons in 2 years, with major banks under pressure for failing to meet high expectations. This month, the S&P and ASX 200 index had dropped 1.9%, marking the biggest decline since February 2022. This sell-off was mostly triggered through the banks, with some banks falling as much as 15%. But outside of the bank, the story is quite differently. Company earnings have been surprisingly resilient. In fact, for every 4 companies that exceeded earnings expectations, only 1 fell short. One of the biggest surprises has been the strength of the Australian consumer. Despite cost of living pressures and rising interest rates, household spending has held up better than expected, providing confidence in the broader economy. In summary, while the banking sector has experienced a correction, the broader market is proving more resilient than many anticipated. The consumer remains strong, commercial property is stabilising, and many companies are still delivering solid earnings. As always, guys, if you have any questions, please do not hesitate to reach out to me. Your financial well-being is our number one priority.